Let me tell you about a day at the park that I spent with my wife and kids about a year ago. Our family had outgrown our small apartment, and we were ready to look into buying a house. My parents had bought a home in the Carver neighborhood a couple of years before this, and they invited us to their annual neighborhood association picnic. They wanted us to meet some folks who could help us learn what we needed to know about how to buy a home. My father and mother introduced us to Pete and Christina Castillo, and we talked with them about the advantages of buying a house, like financial incentives. The Castillos also told us that owning your own home gives you the feeling of really being a part of your community. And if you have a place of your own, you can fix it up just the way you want it. Pete and Christina told us that there are also obligations connected to homeownership, like the need to take care of repairs on and maintenance of your house. And your mortgage payment may be higher than the rent you're paying. Because we were convinced we wanted to go ahead with buying a home, the Castillos told us about the home buying workshop they went to. These workshops are typically put on by lenders and counseling centers, and it's a very good idea to attend one. Your counselor can tell you what you need to know to get on the path to home ownership. One of the first things you'll need to do is analyze your current expenses. This will help you to determine whether or not you can afford the upfront costs, like your down payment, closing costs, and moving in and settling expenses, and the ongoing costs of home ownership, like your monthly mortgage payment, taxes and insurance, utilities, repairs and maintenance, and homeowner association fees. Then you should list all possible sources of funds that can be used for the down payment and closing costs. Your ability to come up with these upfront costs will affect the price you can afford to pay for a home. The next thing you should do is calculate your gross or before tax income by listing all the income that you get on a regular basis. Your mortgage payment shouldn't total more than 28% of your monthly gross income. Now determine how much you're paying each month towards your existing debt. That amount, combined with your monthly housing costs, should total no more than 36% of your monthly gross income. It's a good idea to obtain a copy of your credit report from a credit reporting agency. If you find any problems in your credit profile, this will give you a chance to correct them. You can increase your home buying power by paying off some of your long-term debt, saving additional funds, by holding off buying a home until your income increases, or by finding a financing option that results in a lower down payment. Many lenders offer different types of mortgages to help more people buy homes. There are also programs available through Fannie Mae. Fannie Mae is a privately owned corporation that works with lenders, real estate professionals, mortgage insurers, public agencies, and nonprofit organizations to offer affordable housing programs that are designed to overcome the most common barriers to home ownership. There are mortgages available that require a down payment as low as 5%. If you are making a 5% down payment, the lender will require mortgage insurance. To decide whether you are in a good position to buy a house, ask yourself these questions. Are you sure you want to buy a house? Do you have steady income and stable employment? Do you anticipate remaining in the same location for the next several years? Have you created a budget so you know how much more you can realistically afford to pay for housing? Do you have an established credit record, or can you build a non-traditional credit history with records of payments to landlords and utility companies? Do you have enough money saved up for a down payment and closing costs? Have you pre-qualified yourself, or have you been pre-qualified by a lender, real estate professional, or counselor, so you know how much you can borrow based on your income and existing debt? Is your existing debt low enough that it will not limit your ability to qualify for a mortgage? Have you looked into the benefits and requirements of the financing options that are now available to home buyers of modest means? If you can answer yes to all of these questions like we did, your next step is to look for the house you want to buy. House hunting takes time and hard work, but it's worth it if you find a home that's right for you. After Rochelle and I figured out how much we could afford to pay for a house, the whole family got together to make up a wish list that included all our housing needs. If you do this, you'll be in a good position to work with a real estate sales professional who can show you homes on the market that match your needs. At the picnic, we met Matt and Lynn Davis, and they told us about how they worked with a real estate sales professional to find their house. When you go out with your real estate sales professional to look at houses, explore the neighborhood to see what it has to offer. Be sure to check out what kind of shape each house is in and whether or not it meets your requirements. It's a good idea to keep notes on the houses you see in order to compare them later. You will see a lot of houses as you narrow down the field, and keeping notes on them will help a lot. When you find a house that seems right for you, go back to it and spend as much time as you need to look at it closely. Before you sign any papers or put money down, carefully consider all the factors that go into choosing a home. When you're ready to make an offer on a house, you need to take several things into account: the market value of the house, its condition, the circumstances surrounding the sale, what you can afford, and the financing terms. Your real estate sales professional can help you write up your offer, which will include a number of important terms: the legal description of the property, earnest money, the offering price, the down payment, the type of financing, personal property to be left behind in the house, proposed closing and occupancy dates, and the length of time the offer is valid. There are a number of contingencies that are commonly included in this offer. These are things you want to happen before the contract becomes final. They include home inspection, financing, and appraisal contingencies. After you submit your offer, the seller will either accept it, turn it down, or come back with another price called a counteroffer. You can either accept the counteroffer, negotiate another counteroffer, or back out. All this goes through the real estate sales professional. When the seller signs the agreement, it becomes a formal sales contract, and you'll then need to shop around for a mortgage loan. We weren't sure how to obtain a mortgage, and Sue Taylor, another one of my parents' neighbors, told us how she went about it. We learned that shopping for a mortgage that's right for you isn't easy, but there are ways to simplify the job. Your real estate sales professional or your community credit counselor may be good sources of information about which lenders in your area are offering the best terms. Many real estate firms and mortgage lenders can now provide computerized information regarding current interest rates. Home mortgages are available from a number of sources. Shop around to find a lender that offers the best financing package for you. Comparing various lenders' loan terms can be a confusing process, and use of a mortgage terms checklist can help you make sure you get all the information you need. Once you've decided which lender is offering the kind of mortgage you want with the best terms for your situation, you are ready to make an appointment with a lender. It's very important to prepare for this interview. Filling out a pre-application worksheet will help you be ready for anything that comes up. Also, when you call for your appointment, ask what documentation you should bring with you. You will speed up the loan processing if you bring all the requested documents with you, including the purchase contract, recent bank statements, pay stubs, and W-2 income statements. A lender uses the information in your loan application and documentation to decide whether or not you are likely to repay the loan. They look closely at 4 things. Can you repay the debt? Is it likely that you will repay the debt? Do you have enough cash for the down payment and closing costs? And will you have some financial cushion left over after your home purchase? Will the lender be fully protected if you fail to repay the loan? The process of evaluating your loan application is called underwriting. During this step, the lender primarily will be interested in 2 things: the property you plan to buy and your financial situation. The lender will have the property appraised, order a credit report, verify the information provided, and get approval from a mortgage insurer if required. If everything goes well, the lender will then send you a commitment letter, which is the final approval of your loan. The commitment letter will include the type of loan, the loan amount and term, the loan origination fee, points, the annual percentage rate, and the amount of the monthly principal and interest payment.
Let's see, what does it say?
It's a commitment letter. It says they've approved the loan for our new house.
That's right.
If your loan application is declined, you will need to find out why so that you can take steps to correct any problems or to improve your ability to get a mortgage in the future. Lenders are required by law to explain in writing their decision to deny credit. Here are some of the reasons for a loan denial: low appraisal, poor credit history, insufficient funds, insufficient income, and too much debt. My folks told Rochelle and me what happened after their loan was approved and they got ready for the closing on their house. The mortgage loan closing, or settlement, is a meeting in which your loan is finalized and you become a homeowner. The closing date is set after your loan has been approved and the commitment letter is accepted. The closing is usually attended by the buyer, seller, listing and selling agents, and sometimes a representative of the lender. The settlement agent is the person who conducts the closing. You may be able to save some money by shopping around for a settlement company, and using a settlement costs worksheet can help you to determine which one is right for you. At the closing, all the loan documents are signed and the title to the property is transferred. When you pay your closing costs and remaining down payment, you'll get the keys to your new house. Before the closing,